Hi guys, welcome to this week's session. Glad that you could join us, and I hope we do have some fun today. As you have seen from just the promo for this week's particular show, what I'm going to focus on is what we call in price action trading major trend reversals. Now, why would they be called major trend reversals? Well, simply that on every chart that you're looking at, on every time frame, there are a lot of reversals that take place. Now, we're not going to worry about trading all of those reversals. What you want to learn to do is look for these particular price action patterns that we call major trend reversals. Call it MTR for short, which could mean a lot of things, but for the purposes of what we're looking at, it's major trend reversals. Why is it so important for us to focus on that? I think if you're starting to create your own portfolio of trading strategies as a price action trader, major trend reversals is absolutely something that you need to have in your suite of strategies. It should actually be I think, the core of what you look for and how you trade, because a lot of things emerge out of that major trend reversal. You know, I was just thinking this morning about how to emphasize the importance of major trend reversals as a core of any price action trade. And I reminded myself, that as a martial artist, as a practitioner of Taekwondo, those who know me know that I have a third dan a third dan black belt in Taekwondo. My daughter says she got 3 black belts. Well, yeah, I've got 3 black belts, but third dan black belt. Now, one thing that always sticks in mind when I started training Taekwondo, it's well over 20 years ago, my instructor then used to teach me one particular move, which is almost similar to a roundhouse kick. I mean, there's some refinements to it or differences to other martial arts. But he used to say to me, "This is our bread and butter. You have to get it right. Get our bread." And I just couldn't figure out. I wanted to learn all of these other fancy things and flying kicks, etc. But he insisted that to get into the discipline of knowing our bread and butter, called it Dolio Chagi. And as I progressed up the ranks in different color belts up to black belt, I began to understand why that particular kick was the bread and butter, because everything kind of builds out of it. So similarly, understanding major trend reversals is the bread and butter of any price action trader, because a lot will build out of that. So I really want to focus on that. Another thing that you will see as we go through it, a lot of things that we've spoken about in the past, what is it now, almost 2 months that this show has been going on, come together in your search for major trend reversals. The measured moves, the leg 1, leg 2, levels of support and resistance, hidden levels of support and resistance, the breakout. It all comes into your search or your quest for identifying a major trend reversal. Now, here's a very important thing to say, to mention right up front. I know you might be getting excited about this particular price action strategy. We always have to bear in mind the trader's equation, right? Risk, reward, probability. We can control our risk. We can decide where we're going to take our profits. That's our reward. But we have absolutely no clue about what's going to happen with probability. We can have a fair guess at probability based on our study of our charts and say, hang on, this particular strategy, if I go back, on the 5-minute time frame, if I go back 1 month, on the hourly, I don't know, I might go back 3 months, daily, might go back a year, whatever the case may be. This particular strategy, I know that 60% of the time is going to work. Okay, so you have a fair sense that 60% it will work. Or this one works 80% of the times, or 70%, whatever the case may be. But what you don't know is a random distribution. So out of 100 trades, 60 will work and you make good money. But those 40, those 40 that don't work, when are they going to come? You have absolutely no idea in terms of random distribution. So do bear that in mind. But what I want to point out is with any strategy, you must always have a fair guess at the probability of success, which you get with reasonable certainty, a high level of confidence by looking at your charts and going back and seeing how things have unfolded in the past. Now, with we spoke last week about pullbacks to the EMA. I mean, those, if you master, those have a higher probability of success. I always work on 60%, but I know pullbacks to the EMA, whether it's a breakout phase, first pullback to the 10 EMA, it's got a higher chance of working, more than 60%. If it's coming back to the 20, higher chance of working, it's more than 60%, the 70, 80%, depending on what's happening. But with major trend reversals, it is the reverse. Okay, why do I say it's the reverse? You will lose more times than you win. Whereas pullbacks to the EMA, I work on 60% chance of success out of 100 trades. I will win 60 and lose 40. But with major trend reversals, I work on the reverse of it. 40% chance of success, 60% chance I will be wrong. So out of 100 trades, I will win 40 of them, and 60 I'm likely to lose. Now, question may be, well, how are you going to make money? Well, you look at the full trader's equation, risk, reward, probability. Risk we manage. Whatever your risk appetite, be it 1%, 0.5%, 2%, whatever. It doesn't matter. As long as you know your risk appetite and you always make sure that your risk in the market does not exceed your appetite. So risk you manage. Reward is where the difference comes in. So if the risk reward probability, from the probability side, your trade 60% chance your strategy of working, you can be comfortable that if you take one-to-one rewards, if you aim to get at least a return equivalent to your risk, a one-to-one reward, you should make money. Out of 100 trades, you lose 40. Let's say it's the full risk, so you don't worry about managing your trades. You put the trade in the market, you go away, go do some shopping, do some other work, do whatever. If you get stopped out, you get stopped out. Then you're going to be out 40% out of 100 trades, right? But you continue to trade. If the 60 come through, whenever they come through, that means, again, you're going for a one-to-one, you're going to get a 60% reward, 60% gain minus 40% loss, 20% up over whatever the time frame is. Now, that's on pullbacks to the EMA one-to-one. Okay, that's what I aim for. If you get more, good. But with the major trend reversal, I'm aiming for returns of at least 3-to-1. Okay, whatever my risk is, I'm aiming for 3-to-1, which means there has to be trade management, which means we spoke about last week. A question came from one of the participants on how do I build a position. So if I've taken this particular kind of trade strategy and it's moving in my direction, I will build up a position. So by the time it's done and I think it's time to get out, I'm aiming to get at least overall 3-to-1 out of that. So what does that mean? It means out of 100 trades, I lose 60%. Okay, so let's keep it simple. But I win 40, and if it was 40, I get my 3-to-1. I'm going to get 120% minus the 60 that I would have lost. That's huge, right? 40 out of 100 times 3 to 1 return, call it 3%, that's 120. But you've lost 60 times 1%, if you're going 1%, so I've lost 60%, 1 on 60% return over whatever the time period it is that you're looking at. If you don't get your 3-to-1, if you get 2-to-1 out of it, right? Which you get a higher return out of these trades. You get 81 or 60, 20%. So it's a highly profitable strategy. Things to bear in mind with this, okay? You wait for the setup and you describe the setup. And when it comes, when you set up, you take the trade. You don't worry about the 40, 60. You take the trade, but these trades, they benefit you if you manage the trades. Okay, if you don't, that's fine. You still be able to make some good money, but you miss the opportunity of adding on to the position. So they require patience. I like to, when I'm talking to guys who are changing to price action strategy or changing their strategy, I really talk to them about pullbacks to the EMA, because you're going to have to wait for that, and also major trend reversals, because they're pretty well defined what you're looking for, but you have to wait for them. Now, how often do they occur? On any chart in front of you, you will usually find major trend reversals. I mean, if you trade in a 5-minute time frame, this is one that really can slow things down for you, because you just have to wait for it. You might get 1 or 2 a day, which may end up as a doji on a higher time frame. You may only get 1 that occurs in the session that you're not in. Fantastic. It happened in the Asian session, in the European session that we're in, or the US session. But they're quite abundant. Now, let me take you through the steps of it, so that we can start to just build and develop our minds around it. There's a few distinct things that you need to bear in mind with a major trend reversal. Okay. Not sure my chat keep bumping. But anyway, no problem. So the very first thing that you need to look for. I'm not saying this is a particular one, but I want to point out just a few key steps in it. You always need to have a trend. There must be a prior trend. Major trend reversal means we are reversing out of a trend that has been persistent. And what's a persistent trade? It must have gone for at least 20 bars. So if you're trading the daily time frame, there must be a trend that is persistent for at least 3 to 4 weeks, right? That is a major trend. If you trade in the 5-minute, I'm looking just at the last 3-4 hours to see how persistent this thing is. The hourly, it's 24-hour markets, 20 full day of hourly trend in one direction. That's the kind of trend we're looking at. So just as a rough guide, I'm looking at plus or minus 20 candles or 20 bars. So in any case, let's just change this a bit. I haven't gone through the usual daily setup. I just want to make sure that we do have time just to work through this, because this is quite important. Well, it's a profitable strategy. So you always need to have a trend. There must be a prior existing trend. Okay. Number one, you have to see the trend. You can't kind of guess it. Yes. If you look, we're in gold, right? 5 minutes. If I ever look at this and I'm saying to myself, well, there's a trend here, and I'm kind of going like that. I'm starting to develop multiple, trend lines. This is not this is not price action that I'm going to be looking for this particular strategy. There's other ways to trade it. Okay, I can look at measured moves. There's other reversals that I can trade. Okay, but I'm talking about a specific strategy that we call in price action trading major trend reversal. So there has to be a distinct trend. So there is a pretty distinct trend that you have seen. So number one, you have to have a distinct trend. Then you need to see a break of that trend line. Okay, and we'll go through and look out for a few more. So number one, here's what I'm going to do. I'm going to call it, we need to have a major. Oh, that's not the correct spelling. We need to have a major trend. And I'm just going to define a major trend as irrespective of the time frame, plus or minus 20 bars or candles. Okay, so you need to have that. You need to see that. That's the very first thing. If you can't see it, if it's not distinct, like I've kind of showed you here, don't worry about it. Trade. There's other ways to trade, which I won't go into because I'll get sidetracked. The second thing, so you are looking for a trade where the market is now reversing completely and starting in a different direction. So you want to see a major trend. There is a major trend. The second thing that you want to see, break of the trend line. You want to see a break of the trend line. That's the first indicator that you've seen that, hang on a second, the counter trend guys are getting strong. I mean, the bears have held this quite strongly for a while, but now the bulls are starting to break above that. So we want to see a break of the trend line. When I mentioned this some time ago, with that break of the trend line, you always want to ask yourself, what is going to happen? Or just keep it simple. What happens at the EMA? In this particular example, I'm talking about the 20 EMA. I'm not talking about the 10 EMA. Remember how I use the 10 EMA? The 10 EMA, I want to use it when I see the initial breakout, and I see a pullback to the 10 EMA when I'm trading it. What I'm talking about at this particular moment is this strategy is a break of the 20 EMA. That's the EMA that we're looking at for this particular strategy. So what happens at the 20 EMA? What do I mean by that? When you get to the 20 EMA, you want to see the counter trend traders, the guys who created the break of the trend line. You want to see them, in this case, breaking above the moving average. Why is that important? Well, the moving average is reflective of the average price that the market has agreed on for over 20 bars, right? So the market has agreed on that. That's why we have an EMA. But if your counter trend are strong, they say, well, we disagree with this average price. We just think this thing is undervalued, so we want proper valuation of it. So you want to see that when you get to the EMA, the market is not bouncing off the EMA. If it's bouncing off the EMA, it means at that particular point, the trend is still strong, right? So at the EMA, I want to see a break above the EMA. So what happens at the EMA? What we're looking for, look for break, close above. In this case, if we're looking the other way, to be close below. Okay, because all it to be saying is, okay, counter trend is saying, okay, we don't like the average price, we're strong enough to close above it, and so we don't like it, so we're going to show strength by closing above it by saying we disagree with it. So you want to see that. So you're taking these things as you go along. Then, extremely important for this particular strategy, you want to see a trend resumption. So just using this particular trend line, I want to see the bear trend resume. So if I was in a major trend reversal, I would have seen it close above the moving average. I'd say, oh, fantastic, the bulls are pretty strong. But let me see a trend resumption. Why do I want to see a trend resumption? Because if you are a bear, I mean, you kind of know the moving average may be tested at some point, the 20 EMA, and you're hoping that there are enough other bears in the market to resume the selling. Okay, and you do know that even if the bulls are strong, the bulls are going to know and say, hang on, the bears are going to think in their minds, hey, the bulls are getting strong. let's get out of our trades, but they're not going to get out of here. They want to try and get out at a better price where they were before. Okay, so a bit of the thinking that's happening on either side of the equation. So I want to see the trend resume. That is very important because, well, in addition to what I've said about viscous strength, this previous low here, the low of the trend, of the prior trend, is a magnet. Okay, it's a magnet that's going to pull the market there, because if the bears are strong, they're all going to pile in, and their objective is just to break beneath this with a strong breakout. And if they're able to create a strong breakout, then they're all going to be saying, oh, fantastic, this whole move was purely just leg one, a sideways move to moving average. So now we're still going to go for another measured move. So there could be a lot more for the bears. For the bulls, in this case, it is highly important for them, because they are saying, hang on, we created a close above the moving average to demonstrate our strength. We're going to demonstrate our strength again if the market comes back to this, because we're going to hold our position and make sure the market doesn't go beneath here. Okay, so now what you then get, so you want to see trend resumption, but at the same time as a trend resumption, hold on. No, that's clicking out here. Okay, ignore that. That should go away, hopefully. Okay, when I see trend resumption, with trend resumption, we want to see the low of the last trend. Okay, we want to see the test of the low of the last trend, because we're in a bear market, right? If the trend had been bullish, then of course we want to see the test of the high. But in this case, it's low. That's what we're interested in. We're interested to see what happens here. There's another step that I need to put in here. Call it before the trend resumption, as part of the close above the EMA. I'm going to stick it in here. So that's a very important thing to look out for. So let's call it 3-1. So while we want to see what happens at the EMA, we want to see a close above the moving average. Another very important indicator of strength is a moving average gap bar. For short, for future, I might just go moving average MAGB. Okay, moving average gap bar. That's a full above EMA. Okay, so above or below, depending which direction. Okay. So that's very important there. So you want to see what happens in the EMA to get a close above it. Yes, okay, good strength, and you could leave it like that and go straight to trend resumption, but get good strength. Now, if you also see a moving average gap bar, so there is a close above the EMA, because you might get, here's an example, you might get, see this candle here? Let's say it was occurring in the right context, whatever. Close above the EMA and the market resumes down here. That's still fantastic. But if you get that close above the EMA, then you get another candle that follows whose low is completely above the EMA. There's a gap between the low of that candle and the EMA. That is good strength for the counter trend traders. Not only are they strong enough to get above the EMA, but they were strong enough to put a whole candle above the EMA. So that's good strength. And then you go to the next thing. Let's see trend resumption, and let's see what happens here. So at the test and the low you're looking for the test and the low. Confusing myself. Test low. I forget about the high. The test of the low of the last trend. The high is, of course, if we had a bull trend. But as the market is moving towards that level, we need to be looking at each of the bars that unfold. Remember last week we spoke about the last 6 bars. I think the week before was a trend pullback, but also the last 6 candles. We want to be observing what is happening. If from the trend resumption you got ticks on the close above the EMA moving average gap by looking at the trend resumption, if what you get now is successive bear candles closing on or near the low, when you get here and you see a single reversal candle, don't jump into the trade, because that means you're ignoring the previous 6 candles which we spoke about. If the bears, having observed the bullish strength, if they come back with force into the market and they start to create successive bear candles and they break beneath that, you know, okay, there was a show of strength by the bulls, but the bears are strong enough to control the market on the resumption. So there might be a little bit more that is going to take place. So it's always important to watch the price action candle by candle, bar by bar. What is happening in front of me as the market moves in the direction that I'm expecting. Okay, so keep that in mind and just type that back into what we spoke about last week. If you forget, that's fine. But remember, before you take a trade, you must look back. What happened in the last 6 candles? And that will show you, oops, I may be missing something here, so let me not jump into the trade. So when we get down here to the test of the law of the last trend, if you see dissipating bear strength, there's two-sided trading. There's a bear candle, there's a bull candle, there's a bear candle, and the market is still trickling down, but the bears are not as strong. That's an indication for you that the bulls have strength in the market. They're able to put alternative bull candles as the market goes down. When it gets down here at the test of the low or high of the last 10, we start to look for double bottoms. But what I'm going to write here, remember, you're going to have to kind of invert this in your mind. When you flip back, if you find a reversal in a bull trend, to become clear. But what you need to look for here is double bottoms. Okay. What I'm going to say for you, which will help you as you start to look at charts, when you say double bottoms, we look for variations. So we look for perfect double bottoms. Wouldn't we all just love that? There is a level, market comes and bounces there exactly there. It's like, wow, what a beauty, prepared for me. But it doesn't always happen like that. You might get the market still reacting within there. You might get a slightly lower low double bottom, just a little bit below. Or it might just be a little bit higher. That's a higher low double bottom. It is still a double bottom. So double bottoms are not always perfect. If it's perfect, fantastic. Okay. So if we get our double bottom, we now have the setup. Okay, and that's very important. We don't trade the double bottom. Don't trade the double bottom. You have your setups. If everything is ticked off fantastically, and you get down here, you have a double bottom. Yippee, you're ready. Work out your risk and start wondering if the market turns here, this is where my stop is gonna be, and just start to think through how you're going to take the trade. But we don't trade the double bottom. Double bottom is a tick that our strategy is set up. Now we're going to look for the entry setup. And what we need after the double bottom, we're looking for a higher low. Okay, that's what we're looking for. Now, if you get a double bottom and the market comes back and gives you another perfect test of that, I'm not trading that. I want to see a higher low double bottom. I want to see the bears resume the trend and the bulls deflect them and create a higher low double bottom. That's what we start to look for, a higher double bottom somewhere after we've seen our double bottom being set up. We now want to see the higher low double bottom. And when we get the higher low double bottom, then the last thing that we want is the actual setup. Okay, now we want the entry setup, and at some point we'll go through this. So at the actual, so there's a high low double bottom. Let's assume it is set up somewhere here. Depending how long it takes for it to set up, and there it is. But we must have a good look at that high low double bottom. I get the last 6 candles. Okay, if all of a sudden you had strong successive bear candles coming down to that, don't take it. Just wait for it, and see what happens. We might get that first double bottom, which might work when you're gonna wait for a pullback, or market might come back again, get another double bottom, then you wait again. Okay, but the entry setup, when I see a clear reversal, it could be a 2-bar reversal, it could be those breakout modes that I've spoken about, an inside candle. It could be many different things, but now we're just zoning on that. We've watched all of this thing happening. We're waiting for that entry setup. By the time that entry setup comes, you've already kind of said to yourself, and I'm just using this as that, and you say, okay, that's where I'm going to take a trade. If it comes in here in 25 pip, and I'm looking at my risk, now I'm putting 1% in, so I must take whatever, 0.112 loss, whatever it may be. It's all set up, and all you're waiting for is that entry setup, that signal that then says, okay, plus a couple of pips, whatever is above that, I'm taking the trade, and that's it. You take the trade. Now, because you're taking it down here, right? Why do we say we should be aiming for 2-to-1 or 3-to-1? Because if it sets up the target for the bulls is where this trend started. They want to go and test the top of that trend. And if the overall market on the daily time frame, for argument's sake, is bearish, in this particular session that we're trading, we will get our reversal. We're going to get the trend reversal here, or the Asian session, whatever the case may be. And the trend could still resume forcefully, and the bears will come and smash through this and give us a low close on the daily. That is fantastic, because we are on this lower time frame chart. That can happen. So the bears have made a ton of money here. They trade in intraday, they'll step out and say, well, I'm just going to wait and see. If they're longer time frame based, they don't care what's happening, that the market is doing reversals on the daily. They're looking at their targets on the hourly or the daily, whatever the case may be. So on this time frame, that might be the test. Okay, which means if the market, if the trend reversal kicks in, it's going to kick in with a breakout from down, which is fantastic. Already in a trade, because the breakout, you're going to have to wait for that first pullback to the 10 EMA. You can build a position, add on to that, with pullback to the 20 EMA, until you get to your target, where you take your profits out. You don't hold on to it forever, because that's the target. And then at that stage, if we set up, we start to look for a major trend reversal. If you're still in the market, depending on how long this is taking, it might be the end of your session. Cheers, made my money, I'm gone. Might be coming into, this was the opening of this session, might be coming into another session. And you can say, oh, this is fantastic. We have that, major trend reversal, and keep on trading. So those are the steps to it. Now, just check, okay, there's no question. What I want to do is let's just have a look and see. Just keep those in mind. If we can find one. I'm trying to find one that's a little bit cleaner. Let's have a look at this one and see. So we had a trend. Okay, we're just jumping into it straight. We had a trend, and you come into the market whatever time that is. You can see the trend. Now, another indicator of a trend is, I think what step was that where we said look at the break above the EMA. If you haven't seen a break above the EMA, the market is holding the 20 EMA. It's a pretty strong trend that you're in. In fact, let's start a little bit earlier with this one. There's some things we can learn here. So let's just assume you came into the market at this stage, and you kind of say, well, I'm gonna be trading major trend reversals. Okay, let's go back. Let's say you started here and see what we can learn. And you say, I'm gonna trade major trend reversals. You have a look at that and say, yeah, that is a trend. Would break out here, just barely follow through, put that to the 10 EMA. I didn't trade that. I want to see if I get a break of my trend line. We have a break of a trend line, fantastic. We have a moving average gap bar, but our strategy says, the major trend reversal strategy says, I want to see a resumption of the trend. So I wait, there's no resumption of the trend because I'm trading the major trend reversal. I don't jump into it. And that's a key thing. You've got to stick to the particular strategy you're trading. There's many other ways to trade this, but as far as the major trend reversal that we're talking about, when we're trying to go for these 3-to-1, there's nothing to trade here. Okay, so you watch and you wait. If you have other currencies, have a look at it. If not, just wait. You'd have marked this low. And I'll see what happens here. But we get a break above this trend line. What happens at the EMA? The market resumes again. So the bears that created this trend are just carrying on. Now they have a flatter trend line, but it's still a trend line nonetheless. And you still saying to yourself, I'm waiting to see if I can get into this major trend reversal and see if I can get the opportunities that I get. Now, remember, none of these things should be surprising, right? From what we've spoken about before, because you would have seen there's a bit of a trend range there. You have marked the measured move. You have seen all of that. You said there's a breakout, there's a follow through, leg 1, pullback, leg 2. So everything. Remember I said earlier on, all the stuff that we've covered all starts to come in together. Apologies if I'm going fast, if you haven't come across this. Okay, leg 1, pullback, leg 2. Market didn't get to the leg 2, so there's some bullish strength. Then I get a break above the trend line. I get my follow through. Wow, I get a moving average gap bar that's formed right here. Okay, so what happens at the EMA? What happened at the EMA? The market bounced off the EMA. What's happening here? The EMA, market bounced off the EMA, so the baseline strength. Then you get your break above the trend line. So big tick. What happens at the EMA? Test, break above, close above, bar with a complete gap between the low and the moving average gap bar. So bullish strength, fantastic. And the bears, now you want to see, is there going to be a trend resumption? Because with the trend resumption, what you're looking for is the market to come and test down here. It doesn't quite test. We always said we're looking for double bottoms. We don't quite get perfect double bottom. This time we get a high low double bottom, but we don't trade the high low double bottom. What you are waiting for, we don't trade the high low double bottom. There is our pattern. We got the double bottom, but it's a higher low double bottom. It's higher than that, but we're not trading this. Now we are waiting for a higher low double bottom for us to trade. What you'd have looked for ideally is a higher low somewhere within here. Okay, I'd like to see the market resume. The bears attempt again for the market to There's attempt to break beneath this and the failure and the reversal here. We didn't get that that perfect higher low double bottom. What we got instead was a double bottom, a higher low double bottom just here. Okay. Now, could you have taken that trade? Yes, you could have. But if you take that trade, your stop has to be in the correct place. That's a 60 pip stop. If you don't like that particular stop, if it's too high for you, that's a trade that you would have to take. If you don't like that, you would have to wait a little bit more. And unfortunately, we didn't get anything that's perfect, because even when you get to the 10 EMA, attempt to break beneath it, break beneath the moving average, failed. Would you take that? I wouldn't, because that's an outside candle. That for me indicates the trading range, but the market continued above that. So we didn't get as decent a high low as we wanted, but it did set up. So nothing said about that, but you'd have had to wait. Let's have a look at, let's grab a look at the euro and see if euro can present us something else. Some of these could be all right, let's have a look at this. Classified as MTR, but let's find something cleaner. So there is a trend. Okay, you can clearly see holding beneath the moving average, etc. So whichever way you market, there's a trend. You want to see what happens. So break, oops. Okay, break of the trend line and failed break of the trend line. The market comes back. I ignore this dotted line. That's from a previous level of support that I've got. Failed break, but we have a double bottom that is set up. It's a higher low double bottom. It's still a double bottom. Would you trade that? Would you start to look for a higher low? I wouldn't start to look for a higher low, because then I'm trying to force the trade to happen. Okay. At the moving average, I didn't get my close above the moving average. I didn't even get the moving average get bar. So although it came back and gave me a slightly higher double bottom, and I could look back end of the day and say, oh, fantastic, you've taken that trade. This did not set up as a major trend reversal, so I wouldn't have taken that. Okay. Let's go back a little bit more. Let's have this is a failed one, but let's have a look at it in terms of what you're looking for. So there is a beautiful trend. Okay. Market broke beneath the moving average, and happened in the US session. This is the opening of the Asian session. We do have a moving average gap bar. I mean, things are still forming and setting on the day. Then we have this sideways price action. Now, this sideways price action is still a continuation of the break beneath the moving average, beneath the trend line. Okay, we don't have a test of that level until we get to a couple of hours into the morning session. And what we get when we get there, instead of the market testing that and reversing back into a reversal, we have instead a continuation. So that would serve as a failed major trend reversal. Then what we get later on, although we have, it's not a clean trend, you can see at the break of that trading range, the market went to a measured move. The stuff that we've spoken about in terms of measured moves here. So we do have breakout, pullback. Let's put it. So leg one. Here's the first leg. There's the second leg. So the market breaks above that, you say to yourself, how far could it go? Well, there's leg one to the leg two, so the market goes as far as that. So that is a trend. It's a breakout and a channel. Trend, breakout, and channel phase that we have. So it's a form of it is a trend breakout. It's not in the form of this. This is a small pullback bull trend, but you could also look at first leg, pullback, second leg. But in any case, so we do have a trend there. So you could mark it in terms of the channel actually. So there's the breakout part of it, there's the channel part of it that's giving us a trend. Now, the market breaks beneath the trend line. Okay, we have a close beneath the moving average. We don't quite get a gap bar because although this opened beneath the moving average, there wasn't a gap bar there. So the bears are not giving us a sign of clear strength that they're able to put a full candle beneath the moving average. So that's fine. Let's wait and see if we do get a test of the previous high. Okay, so now we're looking at things completely different to what we had earlier on in the bull market. Later on, we have bears trying to resume. These are no longer moving average gap bars. The moving average gap bar, you want to see it on the first break of the trend line. So what you see here, yes, it's evidence of bear strength. The bears are trying to break beneath this follow through that fails. That's only one candle they go sideways. Then the bulls try to resume the market, and now we get a close enough test of that. Now, once we get that, that can function for me as a double top in this particular example. And if we have a double top, what do you wait for? We've got to wait for a lower high, right? Remember with the double bottom, under the higher low, you get a double top. That's close enough. So it's a slightly lower high double top, but it still functions as a double top test of the previous high of the trend, and bears are strong enough for the resumption. Now I'm looking for the lower high, and the first one that I'll look at is that's the one that I'll look at take, and I'll actually take that particular one. And if you take that, of course, the stop's gonna go exactly where the trend starts. And if it held onto it, you would not have been stopped out. Okay, but you'd have had to trust your stop going through that and say, listen, I had my whole setup here, followed through, analyzed it, and I've seen my low high, I have taken it, and at that stage, I'm anticipating that the market would continue all the way down here. You possibly have said, the market breaks beneath this low here. You might get down here. You might have said to yourself, after that major trend reversal setup, there is a leg one, and there is a first pullback. Yeah, that confirms that the market might want to go there. So you take that trade, you put your stop here, and what you're waiting for to see is if you get follow through and the opportunity to build into your trade. They haven't taken a major trend reversal. Okay, remember we spoke about 40% chance of success because you've taken this particular strategy. When you see all of this, just hold onto your trade. Don't jump out unnecessarily. I mean, you've got to rely on your stop. Only time we start to pull your stop down is if you break beneath this low and get a pullback, then yeah, we can hold the stop. So just hold on to the stop. But however, if in any event you decided, okay, no, I'm not comfortable with what's happening here, there's my entry somewhere near, I want to get out and break even. If you stopped yourself out, if you got out of the trade, that is still perfectly fine. There is nothing wrong with it. However, remember what the setup is. The setup is a major trend reversal. You've waited for it. If you then get an opportunity to get back into the trade, you must look at taking the trade again. So you must just wait, and you see that. You might say, well, okay, I don't want to take that because although it's a decent reversal, it could be my lower high. if you want to take it, put the stop in the correct place. That I would do that. But if you don't want to do that, you're looking at it and you're trying to say, well, why would I take that? And if you hadn't seen any of the other things we've spoken about, like measured moves and understanding why the market is standing there, if you haven't seen all of that and you've decided not to take that trade, then just wait. But you're still off the major trend reversal. That's what we are trading. Now the market resumes. Okay, you get a bit of a pullback. You could take that trade if you wanted to take that, or you can wait still further and look for this inside. That's a perfect setup to take off the moving average. You could take that trade if you wanted to. If I had taken that trade myself personally, then I'm looking for ways to add in because this is still my major trend reversal. So if I've taken that, even if I've gone in with the full risk, when I see something like that or something like that, I'm going to add in into the trade. But from there, my stop now comes down. So a little bit reduced risk. And if you were to add this or that, it might just still be within the risk parameters. Or I could wait for that and take the trade and find ways to build in the trade if you didn't. Or this one you should take. Still off that major trend reversal, you should take that, put your stop there. Here's another one that you'd look at taking. Second entry, we haven't spoken about that. Off the EMA, you should take that particular trade, your stop there. So you either build into positions or just taking trades. You're still aiming to get here and see what happens here. Because the point I'm trying to get to, you are taking a major trend reversal. Remember, we said we're trying to go for the 3-to-1. We're trying to get for the higher return because of its 40-60 ratio. So you take those trades. When the market breaks beneath this low and pulls back in that zone, this is not a close trade in a major trend reversal. You're trying to see what's going to happen at this hidden level of support. I'm expecting there to be some kind of a pullback because the hidden level of support. But I'm looking to build up my position. So at this stage, market has broken beneath here. It's pulled back and it's kind of going sideways. I can pull down my stops and put my stops in this level. If I've taken a trade here, the risk is minimal. Then I wait to see what happens. So I've kept my stops market. I put my stops in that particular area. Okay. And I'm managing the trade. That's what I'm doing. There I'm managing trades. I know this is a level of support. It's a hidden level of support. There's profit taking. But let me see what happens. When I see, we call these climactic bars or climactic candles or exhaustion candles, exhaustion bars, many ways to describe it. It means the bears have been selling and selling and selling, and they're all looking here and they're all waiting and saying, there might be an opportunity to make just a little bit of extraordinary profit here if I'm patient enough. You then get an exhaustion candle, a climactic candle, and we'll talk about that at some other time. That big candle indicates to me that this particular trend is coming to an end. So I've got to find ways to quickly get out and take my profits. That's when you can start to pull down your stop and you get stopped out in here or somewhere in here. Or take as much profit as you can at this reversal here. So you could have built a nice thing, but the point that I'm trying to get across is that you are trading a major trend reversal when you start when you're tracking this. And this one was bullish. So it's a reversal of a bull trend. So if you do it well and manage it well, it's worth the reward of waiting for this strategy throughout the day. If you don't see clean ones, especially when you're starting off, look for the clean ones, wait for the next day. You will pick up your 3-to-1 return, which is a lot more than you could make in a month by just rushing through things. So let's just quickly recap. So I'm not going to flip through to the notes that we wrote on, I think it was in code. Well, let's see. Okay, so remember, major trend, plus or minus 20 bars, break of the trend line, what happens at the EMA, moving average gap bar, trend resumption, test of low high, double bottoms or double tops, high low double bottoms. So here, there's a trend, it's a spike and channel, it's a breakout and channel, so that is a complete trend. Break of the trend line, first tick, looking for the moving average gap bar. Well, what happens at the EMA? There's a test of the EMA, there's an attempt for the bulls to reverse it, they failed. So bearish trend, didn't get my moving average gap bar, but I'm still looking for my major trend reversal. I'm now going to see if I get a test of that. Now, in what situation would I not get a test of that? If the bears who created this, okay, if they had a strong candle breaking beneath this particular level and a follow-through candle, then I now have a breakout after a break beneath the trend line. So the strategy changes. I'm now trading a breakout, moving for the pullback, but the strength of that particular strategy is off the break of the trend line. In this case, we're looking for the trend line, for a major trend reversal. There is our test of the major trend reversal. Now we just look for opportunities to trade. Ideally, perfect, classic one. You could have gotten a lower high. Market tries to resume, got a lower high here. We didn't get that. We had this one strong breakout candle, pull back, and decided to take out trades here. So those are the kind of steps that you look at. So what I would like to ask you to do is just oh, hang on, there's yen. That's today, right? There's a break. Oh, that's classic. There's breakout. So here is one that set up towards tail end of the Asian session. Bull trend. This is a nice one for you to look at as an exercise. Break beneath the moving average. What happens at the EMA? Fantastic. The strength carries on. There's a moving average gap bar. Beautiful. I'm now looking for a test of the trend of the earlier high. There is a test of the earlier high. Okay, now I'm looking for a lower high. There's a lower high. I should have looked at this first. There's a lower high. There is a perfect trade to take. Take it, put your stop above here. And now you're looking for ways to get into it. You may not have taken that, but that's a nice one to take. Why would I not have taken that? I don't like taking trades in the first 6 or so candles of the open, so you could have missed that. Now, what you do here is wait to see if we get another setup, a lower high or so that we can set up. Where are we going? All we're trying to do is see if we get a test off here first, remember? Okay, see if we get a test down here. If we get a test down here, and will the market break beneath this and get to test the low of yesterday, or will it bounce off? But it might still give you sufficient room to trade. But that's a classic setup. A little bit of hesitation here. So you'd have taken that and you'll be holding, because what you want to wait to see, there is a break beneath those lows, pull back. I guess you could put your stop above here. If the market breaks beneath that and pulls back, you could put your stop here and look for a test of the moving average, but still coming off. That's a major trend reversal for now. All right, guys, thank you very much for joining in. Well, I hope you enjoyed it. Any feedback, please pass it on to the admin team, and we can pick up. Thanks, Johan. Appreciate that. We can pick up next week. I've kind of put a long things in, guys, and a lot of things over the times. If you want anything for me to go back to, anything in future things, just pop the admin guys, and not to Angel and the guys pretty quickly today or tomorrow, before I give a topic for next week. I think we're getting to a stage where we can now comfortably just start looking for trades and say, well, let's just wait. And what we then do is I'll add a lot more charts in, even those that I don't trade, and show you that listen, I don't trade these ones, but there's something setting up. If you want to take it, take it. If not, wait. If I see trades setting up on my time, on my charts, we'll take that. All right, guys. Thank you very much. Thanks, John. Thanks, Helen. Appreciate it. We'll catch up next week.